Warren Buffett once called Berkshire Hathaway the dumbest stock he ever bought. Not because the company disappeared, because it survived. In 1964, an argument over 12.5 cents made Buffett angry enough to buy control of a dying textile mill. Decades later, he estimated that the detour had cost roughly $200 billion. That was not a cash loss. It was his estimate of the road not taken. So how did a cheap stock become such an expensive mistake? The answer begins with a deal that was supposed to end quickly. When Buffett started buying Berkshire shares in 1962, the company was already shrinking. It had once been a major New England textile manufacturer. But mills were closing, competitors were moving south, and the remaining assets were struggling to earn decent returns. That was exactly what made the stock attractive. Berkshire shares traded around $7.50. Working capital per share was about $10.25. Book value was more than $20. On paper, Buffett was buying $1 of assets for far less than $1. He was not betting on a textile revival. His plan was simpler. Management would close another mill, release some cash, and use that cash to repurchase shares. Buffett could tender his stock at a higher price, collect a short-term profit, and move on. He later compared trades like this to finding a discarded cigar with one puff left. Ugly business. Cheap price. One last profit. And then you leave. By 1964, Buffett's partnership owned a meaningful position. Berkshire's chief executive, C. Barry Stanton, asked what price Buffett would accept in the next tender offer. Buffett said $11.50. Stanton agreed. A few weeks later, the written offer arrived in Omaha. $11.37.5. The difference was 1/8 of a dollar. Buffett could still have sold at a substantial profit. The rational trade was almost complete. But now the decision was not only about price. It was personal. Buffett felt that Stanton had broken his word. Instead of tendering, he began buying more Berkshire shares. By early May 1965, Buffett partnership had taken control. Buffett removed Stanton, and more than a quarter of the partnership's capital was tied to a company Buffett would later describe as a terrible business. The cigar butt trade was over. Now he owned the cigar factory. This is where a cheap asset and a good business separate. A minority investor can buy below book value, wait for a tender, and leave. A controlling owner inherits everything behind that book value. Factories need maintenance. Inventory absorbs cash. Machines become obsolete. Workers and communities depend on operating decisions. And competitors do not care what price you originally paid. At the time of Buffett's takeover, Berkshire's textile net worth had fallen from roughly $55 million after the 1955 merger to about $22 million by fiscal 1964. The company had no pile of spare cash. The textile operation needed the capital that remained. So the discount was real. But the assets were not free. They came with a business attached. Buffett did not immediately give up. He installed capable managers. They changed product lines, adjusted distribution, reconfigured machinery, and searched for efficiencies. The problem was bigger than management. Imagine Berkshire buys a new machine that cuts production costs by 10%. For a moment, that looks brilliant. Then every competing mill buys a similar machine. Industry costs fall. Competition pushes fabric prices down. The temporary advantage disappears. Every company now has more money invested, but returns remain weak. Buffett used a parade analogy. One person stands on tiptoe to see better. Then everyone stands on tiptoe. Nobody sees better, but everybody is less comfortable. That is the capital trap inside a commodity business. Invest, and the industry copies you. Refuse to invest, and your own factory falls behind. There is no durable advantage. Only another bill. Textiles did contribute something important. In 1967, cash generated or released from the operation helped Berkshire buy National Indemnity, a small Omaha insurance company, for $8.6 million. That purchase changed the direction of Berkshire. Insurance capital worked differently. A textile mill had to keep buying equipment and inventory just to remain competitive. An insurer could receive premiums before paying future claims, creating investable funds known as float. Float was not free money. Claims still had to be paid, and poor underwriting could destroy capital. But disciplined insurance economics gave Buffett something textiles could not: capital that could move. The better the new businesses became, the smaller textiles looked inside Berkshire. But the mills remained an anchor, absorbing attention and cash while the rest of the company expanded. Buffett understood the problem long before he closed the mills. So why did it take until 1985? Partly because the people were not the problem. The managers were honest and capable. The workforce had cooperated. The mills mattered to their communities. And occasional profitable years kept hope alive. Buffett also believed the operation might produce modest cash returns without demanding too much additional capital. He was wrong. After 1979, the business consumed major amounts of cash. By mid-1985, Buffett concluded that the condition was likely to continue. He preferred to sell to an owner who would keep the mills open. No buyer wanted them. The economics that had taken Buffett years to accept were immediately obvious to everyone else. So Berkshire shut the textile operation. The workers paid the human cost of a decision that looked clean only on a spreadsheet. In a 2010 CNBC interview, Buffett returned to the original mistake. He argued that if he had put the same starting capital directly into insurance, instead of first trapping it inside Berkshire's textile assets, the company might have become worth roughly twice as much. At the time, he described that difference as about $200 billion. Again, that number was a counterfactual estimate. No bank account lost $200 billion. No invoice arrived. Opportunity cost is quieter. It is the value that might have compounded somewhere else, while capital, time, and attention remained committed to the weaker path. And Buffett's mistake had a second layer. He placed National Indemnity inside Berkshire rather than buying it directly for his partnership. That meant the future insurance engine was partly owned by Berkshire's legacy shareholders. The textile company did not merely consume capital. It determined who owned part of everything that came after it. It would be easy to turn this into a slogan: never buy a bad business. But that skips an important boundary. Buffett's original Berkshire purchase could have been an excellent short-term trade. In his 2014 letter, he calculated that accepting the tender would have produced an annualized return of about 40% for the partnership. The mistake was not noticing a discount. The mistake was allowing anger to transform a limited trade into a long-term ownership decision, then waiting years to accept what the industry's economics were saying. A low price can protect a trade. It cannot repair a business model. Berkshire Hathaway became a great company because Buffett eventually moved capital away from textiles and into businesses with better economics. The original mill never became great. That distinction is the lesson. Price can create an opportunity. Only economics can support an owner. And sometimes the most expensive mistake is not the money you lose. It is the better machine you never allowed that money to build.